I've been investing for more than a decade. I know how complicated it can be as a UK investor just to understand the basics. Not only can it be confusing, it can also be very expensive. And there are many ways you can get caught out by taxes without realizing it. So here's 6 different hidden tax traps that I think you need to know about, which could end up saving you thousands of pounds now and in the future. First up, let's talk about ISAs. If you aren't already aware, the ISA is a type of account that lets all UK residents invest and save their money completely tax-free. There are 4 types of accounts. You've got the cash ISA, the stocks and shares ISA, the lifetime ISA, and the innovative finance ISA. There's also a junior ISA too as well, but let's focus on the others for now. Now, any money you put into your ISA account will be completely free from any taxes. There's no income tax to pay, there's no capital gains tax to pay, and there's no dividend tax to pay if you were to save or invest in something that increases the value in your account. In total, each UK adult has an allowance of £20,000 per tax year that you can put into your ISA, and this is shared across all of the different accounts. For example, you could put in £10,000 in a cash ISA and £10,000 into a stocks and shares ISA, and that would be your full allowance done until the next tax year rolls on. If that money inside your accounts grows to £50,000, £100,000 or even £1 million, there's nothing to pay in taxes at all, and you can take the money out at any point. Although a lot of people do use some kind of ISA in the UK, most people only use the cash ISA, and most people are still not fully aware of how they all work. If you want a more detailed guide, you can watch this video here after this one, where I go into a few more things that you might want to know. It's worth saying that if you do want to open a new ISA account, especially a stocks and shares ISA, you could use Trading 212. If you open a new account and deposit at least £1, you'll get a free fractional share worth up to £100. Just follow the link in the description, or you can use the code Toby in the promo code section of the app. You just press the button here, find promo code, and type in Toby. I've also done a full guide on how to use the app if you're interested too. Okay, the next 2 tax traps link very closely together, and the first one is exceeding your capital gains allowances. If you make a profit on selling company shares, commercial property, or even your cryptocurrency, you may have to pay tax. Specifically, you could be liable to pay capital gains taxes. Now, as a quick example, let's say that you're using a general investing account and then you've got shares inside of it worth £20,000. If you want to sell all of those shares and you make a profit on those shares, you might be liable to tax. Now, say you bought those shares for £5,000 a few years ago. This makes your profit on the sale £15,000. Therefore, you've made a capital gain of £15,000. Now, we all get a capital gains allowance each tax year, which is currently just £3,000. It used to be much higher, but it's been cut massively over the past 2 tax years. Therefore, you can reduce your taxable gain by £3,000, leaving £12,000 that you might be liable to pay capital gains on. Assuming that was all your gains and losses in a single tax year, you'd either have to pay 18% or 24% capital gains taxes on that amount, depending on whether you're a basic rate or a higher rate taxpayer. And yes, those tax rates also changed recently toward the end of last year, so it's higher than it's ever been. It's your responsibility to report any capital gains to HMRC. There's no magic way of them sorting it out for you. If you're ever unsure with any tax issues, it's always worth getting in touch with an accountant. I'm certainly not your accountant or your financial advisor. I'm just sharing some basic information, but there's always a lot more devil in the details. Just remember that there's no capital gains taxes to pay on any investments that you hold inside of ISAs and pensions, making them really, really important to use. Right, this next trap is very similar to the last one, and UK investors can end up falling into this one just as easily. Let's talk about dividends. So anytime you receive a dividend from a company, whether you just own it personally or have some shares in an investing account, you could be liable to pay dividends taxes. Every UK adult gets a tax-free allowance each year, which as of today is just £500. In previous years, it used to be a lot more, meaning that most people wouldn't fall into this trap. But since the last tax year, more and more people are getting caught out. So for example, if you make £2,000 in dividends from shares that you hold in your general investing account, you'd get £500 tax-free, but then the other £1,500 would get taxed at different rates depending on your income tax band. As you can see, this ranges from 8.75% to 39.35%. This means that on £1,500, you could be liable for just over £590 in dividends tax if you are on that highest rate. And again, you'd have to make sure you declare that to HMRC yourself in a tax return. Again, work with an accountant if you're not sure. I hope this isn't the first time you're learning about this. If it is, you've got a lot of work to do. Now, just like with capital gains allowances, these taxes are not relevant if you hold your investments inside a tax-free investing account like an ISA or your pensions. This is why I can't stress the importance of these accounts strongly enough. Now, most people should have no good reason why they're paying dividend taxes on their investments if they're not already maximised their ISA and their pension allowances. Right, next up is one that doesn't often get talked about much and is a little bit misunderstood. This is called withholding tax, and it's a type of tax that takes place when you receive a dividend from a company based outside of the UK. Now, most countries will withhold a percentage of your dividend payment and keep it as a tax. It ranges all over the world, but as you can see, most countries charge between 15 and 30%. The US, for example, where most of the largest companies in the world are based, charges a 30% withholding tax by default. This means that on a $1,000 dividend payment from a company like Apple, you'd only receive $700 by the time it hits your investing account. Now, luckily, there are two different ways to reduce this bill, and there's even another little final tip worth mentioning which can remove this worry completely. First up, all UK investors can halve this 30% charge to 15% because there is a tax treaty between the UK and the US specifically for this. The only thing you need to do is make sure that in your broker's Apple platform, you fill in the W8BEN form. It's usually a very quick thing to sign and sort digitally, and most brokers won't even let you buy a US stock without filling it out first. A second alternative is to buy an ETF rather than individual stocks, and choose an ETF that is domiciled in Ireland rather than the UK. There exists a tax treaty between Ireland and the US, and as an investor in a fund, you are technically not an owner of the underlying stocks, but only of the fund itself. So for example, you could invest in an S&P 500 index fund that is domiciled in Ireland, where there's a 15% withholding tax, which is already paid by the fund, and there's also no need to worry about the W8BEN form from being filled out. Everything's worked out automatically, and any withholding taxes are already part of the fund. Finally, there is a way to not have to pay any withholding taxes at all, and that is by investing into funds that use something called synthetic replication. Now, most funds that you invest in will take your money and buy real shares in the companies that they own. Now, this is called physical replication, especially when we're talking about an index fund, maybe a fund that tracks the S&P 500, for example. Now, a synthetic fund takes the money and buys a swap contract instead. Basically, they'll be buying something from a bank. He'll give that fund the returns of the S&P 500, but without physically having to own anything. Now, there's always risk here. It's not some magic free way to make more money. However, this does mean that there's no withholding tax to pay, and it's possible to make more in the long run, all things being equal. There's a load more details to cover that could be a whole separate video, but it's still good to know nonetheless. Okay, this is arguably a tax trap that deserves its own video, as there are just so many little details here that most people will have no clue on. Now, I include myself in this bucket too, as there's just so many things that people are left in the dark about. Anyway, one of the biggest traps can happen when you first decide to take money out of your pension and begin the drawdown process. Now, I'm not talking about the state pension here, by the way. This is just to do with private pensions that might have come from a workplace. Now, the moment you decide to start taking money out via drawdown or UFP+, you will trigger the money purchase annual allowance. Now, this restricts the amount that you can put into your pension tax-free from 60k a year to just 10k a year. Now, it's not reversible, so the moment you decide to do it, you really need to understand what you're doing. For example, you could still be working away, not really needing the money, but decide that you wanted to take a little bit of money out of your pension for a holiday or something. This would trigger the money purchase annual allowance. You're now committed, and any hope of putting more money in has been taken away. Now, this could completely change any plans you had of continuing to work and putting money into your pension, so just be really careful on this one. Also, a second tax trap with pensions might happen if you decide to take a lump sum out, especially if it's a large one. Doing this could put your income tax bracket up and end up costing you way more money in taxes, when you might have been better off just waiting for a new tax year to roll over, or just making sure that you plan things a bit better. Now, many people can find themselves on the wrong tax code or paying too much upfront to the taxman because their annual income is worked out from a single big payment and assumed to carry on. Now, obviously, you don't have to worry about taxes if you're taking out your 25% tax-free lump sum all in one go. But if you are drawing down a pension and gradually taking out the tax-free part, you do need to consider what the taxable bit will do to your income. And if you don't plan it well, you could end up falling into some kind of tax trap. You see how complicated this all can get? Now, the final trap in pensions is for anyone earning in the higher and additional rate tax bands. If you're paying into a pension, you could be missing out on a lot of tax relief that you need to claim back personally, as nobody else is going to do it for you. Basically, if you're in those higher rates of income, you could be missing out on 20 to 25% worth of tax relief. Literally, billions are left unclaimed each year from people who don't realise they're entitled to do it. In order to check if you're missing out, you'll first need to ask your workplace how your pension contributions are paid. If they're paid before tax, then you don't have to worry about anything and you can ignore this. However, if they're paid after tax, then you will need to look into claiming back that additional relief yourself. This also applies if you've been paying into a private pension on top of your workplace one, as any money you've paid in will definitely be paid in after tax. You can do this really easily now, and I'll make sure to leave a link in the description to the HMRC website. Also, you can just Google it too, and it should be the top link anyway. It's pretty easy to do, and you'll just want to make sure that you've got all of your details ready to submit. That tax relief will come back to you as cash, and you can go back through multiple tax years too. If you don't claim it, then nobody else will. So make sure you don't fall into the trap of doing nothing and costing yourself a small fortune. Finally, I did just want to mention the inheritance tax trap. As of the last budget towards the end of last year, your pension will form part of your estate from April 2027. At the moment, pensions are not something that count towards your estate, and your beneficiaries can receive all of it free from inheritance tax. Once this changes, a lot more people are going to fall into paying inheritance tax, where at the moment it only affects a small number of all estates in the whole of the country. How you deal with this is up to you, but I did just want to highlight it as a reminder because I'm sure that there'll be plenty of people out there who aren't even aware of this change. I think it'll be worth getting in touch with a financial advisor if you aren't sure what to do and need some planning advice. But generally speaking, it could end up costing your beneficiaries a large amount in tax. If you combine the inheritance tax with the potential income tax as well, then there could be a whole lot that needs paying. And this might affect your decision about how you spend your money while you're around, rather than just trying to pass on a big old pot of cash. Anyway, I hope you found that useful. If you're looking for the guide on stocks and shares ISAs, you can find that video here. I'll see you in the next video. As always, happy investing.